All right, today, using ValueLine's digital platform and investor tools, I'm going to show you how to quickly and easily find worthwhile investment candidates. Going further, I'm going to recommend one stock to buy right now. As mentioned, after the presentation, we have allotted time for questions and answers. To start, for those joining us for the first time, I want to provide a brief overview of who we are at ValueLine. We are a New York headquartered corporation that is providing investment research for more than 85 years. Our flagship product is the ValueLine Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, NASDAQ, and Toronto Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by ValueLine's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, ValueLine has no investment banking business with any company, including the 1,700 that are included in this service. ValueLine does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. As part of the formal presentation, I thought it worthwhile to include an overview of the economic situation, as well as the ValueLine Research Department's view of the stock market. Obviously, this can help us get an idea of what kind of stocks to target. The following content was prepared by Harvey Katz, ValueLine's chief economist. Wall Street's focus has shifted away from the economy to a degree. In part, this evolving emphasis is due to the calendar, as data on manufacturing, employment, home building, and producer and consumer prices are already in the books for this month, although reports on consumer confidence, the gross domestic product, and durable goods orders still are a few days away. Also, our nation is in a steady but uninspiringly familiar upcycle, which continues to generate few headlines. So, not surprisingly, the economy is being upstaged by national political affairs. Earnings reporting season has come and gone, and here, unlike events offshore, the news has been supportive, as more than 70% of the companies in the S&P 500 index have exceeded profit expectations for the second quarter. True, there have been disappointments, and these have been dealt with harshly. On balance, however, the performance has been sufficiently positive to keep Wall Street's bulls on board. So, it is logical that politics and geopolitical events have stepped in to fill the void. Here, the news is less supportive. Not only has the administration's legislative agenda stalled, but the looming debt ceiling debate has not even begun. Meanwhile, the Cold War with North Korea remains on the front burner, even if the immediate crisis seems to be cooling off somewhat. On the other hand, the chance of a trade confrontation in Asia or North America appears significant. The Federal Reserve will soon be on the calendar. In this case, though, the outcome seems well defined in the near term, with recent pricing data, notably stable levels of producer and consumer inflation, dampening the case for monetary tightening at this time. The Fed next meets in September. Thereafter, much will depend on the flow of data. Meanwhile, the bulls are meeting with some resistance, which is understandable given the unsettled relations with North Korea, the recent attack in Barcelona, and the high PE multiples in place. Encouragingly, though, the selling has been limited and often countered with buy programs, attesting to the staying power of the aging bull market. In conclusion, we think stocks still are reasonably attractive. However, we also are mindful of the increasing risks at these levels, in particular during these unsettling times at home and abroad. Now for the core presentation. As you can see, I am currently at our homepage, www.valueline.com. On this page, you can access, free of charge, daily market commentaries, as well as general interest articles that are written by our analysts. Examples of such content are analysis of economic releases and quarterly earnings supplementary reports on the 30 components of the Dow Jones Industrial Average. I'm now going to sign in with my username and password. After entering my credentials, I am taken to the welcome screen. From here, I can quickly get to many important areas of our website, including Browse Research, which is the main home for our core equities products. I can also head to our investor tools, as well as home pages for our monthly stock selection services. That said, for this presentation, I want to start at the dashboard, which is the main landing page for subscribers. As Harvey Katz mentioned in the market commentary, and I quote, "We think stocks still are reasonably attractive. However, we are mindful of the increasing risk at these levels, in particular during these unsettling times at home and abroad." I personally believe that this is a logical belief, especially in this market. On that note, let's take a look at how the 1,700 stocks in the Value Line Investment Survey are being valued at this time. To do this, the weekly summary and index is a good place to start. This 40-page PDF can be accessed via the quick links. Let me go back there and just show you. All right. As you can see in the box on the left in the middle of the page, the median stock in our universe is trading at almost 19 times our 12-month share earnings estimate to March 2018. This is a good time to mention that Value Line's estimates are created completely in-house by our research team. Our PE calculation is also different than many other research houses. More specifically, we use a combination of reported figures and estimates for our PE ratios, which we think is better than using a trailing figure or just estimates. The PE of 18.9 on a historic basis is a bit high, but it is lower than what it was in July and is consistent with levels reached during other multi-year bull rallies. It is important to note that the major indexes have all recently hit new highs. For example, the S&P 500 index is now valued at around 2,450. 5 years ago today, it was only a few points higher than 1,400. That is a gain of almost 75%. All told, we think there are still plenty of worthwhile investment candidates, but it is vital that we separate the good from the bad. For our search, I'm going to consider price to earnings, as well as dividends and appreciation potential, the other two boxes on the page. Let's now go to the screener and find some candidates. This important investment tool can be accessed via the Find Ideas tab at the top of our website. Subscribers have access to more than a dozen preset screens, as well as 50 fields. I should also note that the screener possesses more than 200 fields in total, but those are only available with a higher level of subscription. I'm now going to run a screen with some of the information that we already discussed. Naturally, let's start with price to earnings. As mentioned, the median is 18.9, so I'm going to focus on stocks that are currently trading below that level. I can accomplish this a couple of ways. First, I can use the sliding horizontal bar to set my custom range. Or I can just type the values in the from and to boxes. So I'm going to type 18.9 into the to box. That's my high range. I also want to remove stocks that are trading at very low multiples, which often implies that something besides earnings is impacting the stock. That can be a legal matter, recent management turmoil, or signify an industry that is currently out of favor. Thus, I'm going to set the low bound to 5. Hit filter. All right. I'm now going to add dividends to my screen. As you probably recall, the median dividend paying stock under Value Line Review was yielding 2.1%. Let's only look at stocks that offer yields above that percentage. Okay, down to 480 candidates. For the long-term part of the equation, I want to make sure that my candidates are expected to grow earnings at a healthy rate over the next several years. Thus, I'm going to once again utilize Value Line's proprietary estimates and focus on 3 to 5 year earnings growth projections. For this, I'm going to set the low bound to 12%. These stocks overall are expected to advance their bottom lines by a hefty annual percentage out to the 2020-2022 timeframe. Down to 46 stocks. So after just a few clicks, we narrowed down Value Line's universe of 6,000 stocks down to just a few dozen. However, that's still too many for this exercise. Harvey Katz also mentioned that, and I quote, "We are mindful of the increasing risks at these levels. So let's incorporate risk into our screen, and Value Line makes it easy with our proprietary safety ranks." The safety rank, as the name suggests, measures the total risk of a stock and is arranged on a 1 to 5 scale, with 1 being the most stable issues. I want to highlight the fact that stocks ranked favorably for safety have, in the past, held up far better than the broader market during corrections and downturns. For this, let's focus on stocks that have risk profiles that are better than average. So I click on the field and select 1 and 2. Okay, 6 results, which is a manageable list. Any of these stocks may well fit nicely in an equity portfolio that wants to focus on inexpensive or fairly valued stocks with upside. Of course, we also incorporated current income with the dividend component and volatility with the safety rank. Before I move on, please note that users can save screens and revisit them later by utilizing the button at the top. If you are like me, you tend to watch a batch of stocks for a few days or weeks before seriously considering taking a position. Value Line's Watchlist tool makes this easy. I can access the watchlist from the menu above or from Browse Research, which I'm going to do now. To save time, I've already created the watchlist for these stocks, but the process is quick and easy. A quick glance at the 6 stocks, and you may notice that several of them are trading well below the 3 to 5 year target price range, suggesting ample appreciation potential. Of these stocks, I'm recommending, in particular, a closer look at Cardinal Health, ticker CAH. In fact, in my opinion, it is one stock to buy right now. Let's see why. Clicking on the company name will take us to the equity's digital report. As you can see, the data, information, and analysis is arranged in more than 15 modules or boxes. These modules can be moved around, resized, and hidden so you can create your own customized stock report. For instance, let's say I'm most interested in the analyst commentary. I can simply click and drag and move it to the top. In addition, now I want to see more rank-related information. For that, I simply click on the larger rectangle in the heading. Once I alter the presentation to my liking, I can save the changes from the sliding horizontal action bar. The next time I come to this stock report, it will look the way I set it up. Let's get some quick information about Cardinal's operations. So I'm going to scroll down to the Business Overview module. As you can see, the Ohio headquartered corporation is a leading provider of products and services to the healthcare industry. The company derives the bulk of its revenues and profits from its pharmaceutical segment, and Cardinal employs more than 37,000 individuals. Let's now view Cardinal's recent price action. From the valuation module, I can quickly pull up a stock chart, and the yellow line is the equity's performance. As you can see, it has declined over the past few months. In fact, year to date, the price has dropped about 9%. For comparison, the S&P 500 index is up almost 10% over the same time frame. I'm now going to take a look at the analyst's commentary to get some information in regard to why Cardinal has materially underperformed the broader market of late. Towards the bottom of the first column, editorial analyst James Flood stated, "Conditions in the generic drug market remain difficult. Cardinal has historically made its profits by taking a small slice every time the price of a drug rose. With drug prices now being a political issue, Big Pharma is being discontent from both insurance companies and the general public. Thus, even though Cardinal sales rose in the June quarter, net income generated from the pharmaceutical segment declined 7%. Most of the decrease was a result of reduced prices in the generic market. I now want to show you our classic PDF report, which is included with the digital subscription, and provide some analysis on why we think operations will improve and the stock will trade for more than $100 during the 2020-2022 timeframe. Accessing the PDF can be completed via the tab in the gray bar. Going back to James Flood's commentary, in the fourth paragraph he states, "Despite the cyclical downturn, we remain optimistic regarding Cardinal's long-term prospects. In response to current conditions, management is cutting costs and probably identifying non-core assets that can be divested. Over the past several years, the company has been successful in making key acquisitions, and we expect this strategy to continue. Also, Cardinal has a solid position in the drug wholesale sector as it supplies drugs to over 100,000 locations on a daily basis. As you can see in the statistical array, make this a little bigger for you, Dialine is projecting healthy top and bottom line gains over the next several years. As mentioned, the stock has performed poorly of late, but the bad news appears to already be reflected in the stock price. As such, we think that patient investors will be richly rewarded here. We strongly suggest that our subscribers carefully peruse our full report for more information." Another useful investor tool that is available to Dialine subscribers is the Alerts Hub, which can be accessed via Find Ideas. Users can set up notifications and receive an email or text message when a notable event occurs for a specific stock. You can set up alerts for a variety of events, including when the price of a stock moves considerably, when there is a trading volume spike, or when Dialine changes the rank of a particular stock. In total, more than 15 alert functions are present. Let's quickly set up an alert for Cardinal Health. So let's set up something in regard to the price. For instance, let's say you don't like the current price. You want to buy it when it hits a lower level, let's say 60. So this is going to send me an email if that situation happens. As you can see, I now have 2 alerts for Cardinal Health. Price drops below 60. And I like to know when Dialine puts out new reports on the information. I hope you found the method for finding a stock to buy right now interesting, informative, and efficient. I do also want to point out, however, that Dialine offers a variety of model portfolios that can help alleviate the work of finding worthwhile investment candidates altogether. Part of the Dialine Investment Survey is the weekly Selection and Opinion newsletter. Along with economic and stock market commentary and data are 4 model portfolios. I'm going to show you those now. Each one has a different investment strategy, is actively managed, updated each week, and always contains 20 stocks. The portfolios are overseen by senior research analysts. Portfolio 1 is best suited for aggressive investors and focuses on stocks that are expected to outperform the broader market over the year ahead. Portfolio 2 should be of interest to more conservative investors. It focuses on dividend-paying stocks that also offer worthwhile appreciation potential. Portfolio 3 chooses equities with long-term price growth potential and, of course, is best suited for patient investors. Portfolio 4 is filled with stocks that possess above-average dividend yields and is for investors seeking current income. We have a great number of subscribers that follow these portfolios. For those interested in possibly adopting one of these strategies, here are a few helpful details. New positions always amount to 5% of the market value of the respective portfolio at the time of the trade. Any dividends received are simply taken as cash they are not reinvested. Lastly, the portfolios are not rebalanced. All told, the model portfolios represent some of the Value Line Research Department's best investing ideas, and we recommend that you read the analyst-created content and look over the portfolios for possible additions to your holdings. Subscribers looking for a total investing solution are also encouraged to check out our monthly stock selection services, Value Line Select, Dividend Income and Growth, and Special Situations. If this is something that sounds up your alley, please call 1-800-VALUE-LINE and we'll furnish you with a free report. This marks the end of the formal presentation, and I will now take your questions. So bear with me. Let me get up to the top. It looks like there's a few. Okay, first question. On your reports, I sometimes notice a lowercase d next to some figures. What does the D mean? All right, this is actually a question we get fairly regularly. The D signifies deficit or a negative number. It's a good thing to note that not all companies that we cover are profitable. Quite a few of them are losing money on a quarterly or annual basis. All right, next question. Does Value Line provide research on ETFs? Yeah, we actually have 2 ETF products. The Value Line ETF survey provides data and screening capabilities on all the ETFs listed in the US and Japan. It's more than 2,000 ETFs. We also recently launched a new product, Value Line Select ETFs. This product each month recommends an ETF for purchase. It's a 15, 20-page report, and it gives full analysis on why that particular ETF was purchased, or recommended, I should say. Next question. In your analysis, does Value Line use GAAP or non-GAAP? We try to use GAAP whenever possible. However, we do adjust for non-recurring gains or losses, discontinued operations, any other special items. Each stock is looked at individually, and our analysts decide which figures to display. This is actually why, and we get this question commonly, this is why sometimes our figures don't match what a company reports on their annuals or quarterly reports. All right, let me just take a quick scan and make sure I didn't miss any other questions. Oh, one question we got is, are your past webinars available online? Yes, we post all these on our YouTube channel, and they can also be accessed from our homepage. Okay, we got a couple more questions. I missed the recommendation. I had to fuss with the computer. So the recommendation today was Cardinal Health. As I just mentioned, we do post this content onto our YouTube channel. It'll be up within 48 hours. All right. Next question. Where did you get the summary of all stock PE, dividend rate, and index pages? All right. That was in the summary and index. I can show you how to pull that up again. So after you sign in, you can go to the dashboard, and just right here in the quick links is the summary and index. And those 3 figures I mentioned are right here in the middle of the page. I highly recommend that you review these. They're updated weekly, and they give you a really good kind of indicator on how the overall universe is being valued by the market. All right, next question. Why does Value Line not include free cash flow on the PDF reports? There's a lot of different ways to calculate cash flow. We think ours is a good indicator of how a company is being valued. There's literally, I don't know, probably 10 or 12 ways to calculate cash flow. We're not saying ours is the best, but it's the one we chose. Another question. Should I call 1-800-VALUE-LINE for an opportunity to test drive the computer system? Yes, if you call 1-800-VALUE-LINE and speak to one of our associates, they can set you up with a free trial. Yes. They can also do demos for you. And of course, these webinars serve as a pretty good idea of what we offer. Next question. Where would an investor find previous results of the 4 model portfolios? We don't typically post those on our site, but if you email us in the Contact Us section on our site, we can typically provide that those past results. Okay. I've noted that there is sometimes a considerable difference between the ranking system and the assessment in Value Line Select. Okay. Why is this? All right, that's a good question. For Value Line Select, we for those of you who don't know, we pick 1 stock a month. It's our best pick from a risk reward standpoint. So we use the Value Line ranks as one criteria for those picks, but we also look at a whole lot of other criteria such as near-term earnings, long-term earnings, the value of the stock. We try to find ones that are inexpensive or fairly valued. We, of course, look at cash flows, like we just mentioned, other growth drivers. So occasionally, the rank might not be stellar, but we like it from a whole lot of other angles. So that's why that stock is highlighted. Okay. All right, what else do we got? All right, besides a watch list, is there a way to enter a portfolio? Yes, one of the other investor tools that we offer is a portfolio tracker. I'm going to show you that right now. So you can put your trades into that. And here it is. All right, a lot of questions coming in, so please bear with me. Okay, does the cash flow line intend to represent operating cash flow, free cash flow, or other? It's operating cash flow. Let me pull that up on the report. A lot of people use this as a good indicator of whether a stock is undervalued or overvalued. As you can see, the cash flow line, that's the solid line, and then goes dashed to show that our estimates. For Cardinal, for instance, as you can see, the cash flow line is currently trading well above the current stock price, which is that black dot. That's one indicator to show that Cardinal Health, we believe, is undervalued. And as you can see from the relative PE, it's trading at a discount to the overall market. How much do your analysts depend on technical analysis? We look at technical indicators, but mostly we provide fundamental analysis. We look at, obviously, moving averages and stuff like that. And occasionally we'll mention that kind of stuff in the commentary, but we mostly focus on fundamentals. All right. Another Value Line Select question. Will the bonus stock pick within the Select universe be tracked with supplementary reports? We will provide periodical updates on those bonuses. For those of you who don't know, as I mentioned, Select gets one major pick a month, but the last few months we've been putting forth a bonus, kind of more speculative pick, and we'll follow up with supplements, especially a sell recommendation when that occurs. I think I got all the questions. Thank you so much for them. That was great. I really appreciate that. All right. Well, I hit all the questions. If I missed one, I apologize. Please add it. You can email us at the Contact Us section at the bottom of our site if I missed one, and I will respond. Otherwise, thank you very much, and enjoy the last few days of summer.